All right, long-term liabilities. Long-term liabilities are a way that companies use to finance expansion or operations or going into a new business line, buying new property, plant, and equipment. And when you're doing things like that, you have one of two choices. You can either raise capital by selling additional shares of stock, or you can borrow it with what is known as OPM. You all heard of OPM? Other people's money, exactly. Debt has some advantages. You can deduct interest that you pay on debt. You cannot deduct dividends that you pay on stock. You also maintain control. Because a lot of people, a lot of entrepreneurs out there think that going out and getting what is known as venture capital or an angel investor is a good way to raise money. But what's the cost of that? If you go out and you give away to an angel investor, whether it's your Uncle Henry or whomever, a portion of your business, what's the cost associated with that? Well, whatever percent, you could eventually give away enough to where you no longer have the company. What you're giving away is all future revenues. All the income that this company is ever going to make, all of the future growth, expansion. There's a very, very famous story about Facebook. Facebook, in its early days, when they moved into their offices, had a street artist, a graffiti artist, come in and paint a mural in the Facebook headquarters. Has anybody heard this story? It's famous. They gave that artist stock in what was then a privately held Facebook. It stands as one of the most expensive pieces of art ever created in the history of mankind, because that stock was eventually worth more than the Mona Lisa and Michelangelo's David and all of the famous paintings you've ever heard of. So giving up stock should be a last resort, not a first resort. Okay? Just a word of caution. All right, types of long-term debts, and the ones that we're going to be focusing on here are bonds payable. Bonds are a security instrument. You have to register. If you're going to sell bonds to the general public on an open market, you have to register them just like you register stock. When you sell a bond in an open market, you are now a publicly traded company. Even if the bond is the only thing you sell, you are now required to report to the SEC everything that publicly traded companies report. You need to tell the SEC and publish in what is known as their Edgar database your audited financial statements. You need to include salaries and stock ownership of key employees. All sorts of information is required now to be reported just for selling a bond. In here is also notes payable, long-term notes payable. Remember the difference between the two. Current liabilities are everything that's due and payable in the next 12 months. Or an operating cycle, whichever is longer, but 12 months for the overwhelming majority of entities. So what about a mortgage payable? A mortgage payable is normally a term note that you pay for monthly. So is that long-term debt or is that current liability? It's a trick question. It's both. Because the portion of that mortgage, the principal portion of that mortgage that you're going to pay off in the next 12 months is a current liability. Everything else is long-term. Okay? All right. So here's an example of mortgage. Monthly payments are $1,600. You go through and you calculate what the interest expense is. In this particular case, it was $1,000. So you reduce the liability by $600. So each month, when you make that cash payment, you're going to have a combination of the two. And they vary from month to month. Because as you pay down the outstanding debt on that mortgage, your interest goes down proportionally. And then each payment, the amount that goes to principal goes up. All right? And that's the same with a car. That's the same with any loan that you will ever sign. All right? Early in the life of your car loan, you're going to primarily be paying interest. Later in the car loan, you'll be primarily paying for principal. Okay? This is how you calculate it, and this we're going to use on both. This particular case, it's a 12% loan, or 1% per month. So you take the outstanding loan, which at the date of signing was $100,000, multiply it by the 1%, that's the interest. Subtract the interest from the total cash that you pay, and that gives you how much you reduce debt. This is a standard amortization schedule. And we're going to be doing something similar to this when we talk about bonds. And that's just one portion, one of the 3 questions on the final exam. Long-term leases are also, and I'll just mention it here, you can lease assets, and they are either capital in nature, which means you are in essence buying the asset, and there's a series of 4 rules that if you meet any one of those 4 rules, and I'm not going to go into what those are at this level, just be known that there is these rules, and that creates a liability. If it's an operating lease, you're not buying the asset, you're not taking control of the asset, you're not using it for most of its economic life. And so on those cases, that's just rent. That's just lease expense and credit cash. There's no liability that goes on to the balance sheet. That only under a capital lease. I'm not going to worry about recording it. Bonds. So let's talk about bonds. I actually bought a bond at some point in time, an old expired one. I've got it down in my office somewhere. Can't lay my hands on it. I tried to bring it into intermediate accounting, but we'll talk about them anyway. Bonds are a security. They have an actual bond certificate. Well, the way bonds used to work was they used to have coupons at the bottom of them. Little pieces of paper. And they were bearer bonds. Whoever physically had possession of the bonds had the rights to collect not only the interest, but the value at maturity. So people used to keep these locked up in their safety deposit boxes at the bank. And then once a quarter or twice a year, bonds traditionally paid quarterly or semi-annually, they would go down to the bank with a pair of scissors and they would clip out the little coupons and write their name and address on the back of the coupon and mail it off to the bond issuer, and the bond issuer would send them a check. Now, just like dividend checks, it's electronic. You register the ownership of your bond through your broker, however you bought it, and then they send you the interest. All right? So, one, it's safer because people used to steal bonds all the time because they were valuable. And 2, it's a more efficient way of the bond issuer to send money out. So it's a security of some sort. There's evidence by this bond certificate. The issue is the entire number. You could be issuing 100 bonds, each at $1,000, and raise $1 million. All right? So $1,000 is normally the increment that bonds sell at. Bonds are quoted in terms of a percentage of the face value. Because printed on the certificate, on the bond itself, is how much is it worth, when does it mature, how much interest does it pay, and how often does it pay it. Does it pay it once a year? Does it pay it semi-annually, twice a year? Does it pay it quarterly? Does it pay it monthly? How often do they send out these interest checks to the bondholders? And as I said before, the overwhelming majority of bonds pay semi-annual interest. They'll pay it on the 1st of January and the 1st of July, or they'll pay it on December 31st and the 30th of June, somewhere along those lines. If you look at a bond that is currently being quoted at 103.5, and you can go out to the Wall Street Journal and look at the marketplace section in the Wall Street Journal, go to the bonds, and you'll see them. They're all either 99, 92, 101, 103, 105. That is the price that it's selling for that day. And I'll tell you here in a second why it sells for these prices. So that's a bond, in this case a $1,000 bond, that is, if you wanted to buy it, you'd have to pay $1,035 for it. So that's 103.5% of the face value. All right? As I said, there are face interest rates printed on the bond. How much cash is this bond going to send to the bondholders? That is not necessarily what the market wants. So let's talk about the way markets work. The higher the market perceives the risk, all right? You know what risk is, right? The risk is the probability of something happening. If they think it's that you, as the bond issuer, are a very risky investment, you're Detroit, okay? They're going to want more money from you to lend you money, right? That makes sense. If you've got a probability of never collecting this money, you better be getting paid well to lend it. If you're Microsoft, on the other hand, Microsoft doesn't sell. Apple did. Apple sold a bond, issued a bunch of bonds here recently. Or the worldwide standard for zero risk is U.S. Treasury bonds. If you're the U.S. Treasury, the chance of you getting your money back are pretty darn good. All right? That's what the world thinks. And so Treasury bonds pay absolutely minimal interest, which is good news for us as taxpayers because we've got a lot of them out there. We've lent an enormous amount of money to the world. When the face value and the market value are different, the bond price will be different than the face value. And this is how it works. And this is what I'm going to be emphasizing. If you're paying, for example, 10% interest, to keep it simple, the bond, you're the bond issuer. If the bond is paying 10% interest and the market only wants 9%, in other words, the face interest rate is higher than the market. For an investment of similar risk, the market only needs 9%. They will reward you for your generosity and give you more than your face. You will sell that bond at what is known as a premium. And I'm going to show you here with present value tables how we get there. All right? So that makes their effective yield equal to the market rate, because they're paying you more up front for that extra interest that you're going to send them every 6 months. So what happens if the opposite happens? What if the market wants 11% and you're only paying them 10? What are they going to do to you then? They're going to penalize you. They're going to need, in order to get an effective interest rate of 11%, they're going to need to give you less than the face rate up front. They'll buy it at a discount. Okay? So that's where we're at. It's the comparison between the face interest rate and the market interest rate either generates a discount if the market is higher than what you're paying, or a premium if the market is lower than your premium, than what you're paying. All right? I'll just go through this. The overwhelming majority of bonds are unsecured. They're not tied to an actual asset of any type. You know, they're just tied to the good credit of the issuer. Secured bonds have assets as a guarantee. Okay? Now, I don't know that Toyota issued a bond to build the plant down on the east side of town, but if they had, maybe that was a secured bond because they tied it to the factory. So in case if they had defaulted, not paid the bondholders can come in and lay claim to the factory and own it. All right? I don't know that they did that. Term bonds are the vast majority of them. When you issue a bond, they're due all at the same time. 5 years from now, 10 years from now, 20 years from now. For a while back in the late 80s, Japan was issuing 100-year bonds. Even then, it made the Wall Street Journal, thought it was so unusual. Who in the world's going to buy a bond that their great-grandchildren are going to inherit? I mean, why would you do that? But they were selling them, and people were buying them. Serial bonds are ones that you issue one bond, and then you split up the maturity. So you'll have a group of those bonds will mature in 5 years, and then another group will mature in 10, another 15, 20, and so forth. Kind of helps the bondholder repay the bonds because they don't all come due at the same time. They're not as common. You won't see this as often. The common ones are unsecured debenture bonds, all maturing at the same time. I'm not going to worry about those. Registered is the way it works now. Coupon used to be. They used to have, like I said, they used to have coupons for the amount. You don't find that much anymore. All right, so let's look at something. We issue a 9% bond for a total of $200,000 for 5 years. And they sell for exactly the face value, which means that on that particular day, that particular company's debt securities were considered equal to 9%. Because it all depends on who the issuer is. What does the market perceive is the risk in that one particular company's issuance? Because Apple's going to have a much more favorable risk assessment from the marketplace than does, who's currently in trouble? Radio Shack. That's a good one, yeah. Radio Shack's in real trouble. I used to use Blockbuster, but nobody even remembers Blockbuster, so they're so far gone. Okay? So it depends on the particular issuance. If that's the case, the journal entry to sell this bond is just a debit to cash for the full $200,000 proceeds and a credit to bonds payable. The interest is going to be 9% because they're paying semi-annually. 9% times $200,000 I'm sorry, 9,000. 9% of 200,000 is $1,800. That's in total for the year what they're going to pay in interest. And they're going to pay it in 2 equal installments of 9,000 each. So when we get around to, all right, well, let's see here. When the, well, now all of a sudden we're into a journal entry for a discount. I don't understand this. All right, we'll come back to this. So anyway, this one is going to be a credit for $9,000 to cash and a debit to interest expense for $9,000 because it's exactly the same. If the bond sells for less than the face value, in this case we've got a same $200,000 bond that is selling at 96.149. So the proceeds are going to be $192,298. We're now getting a discount on bonds payable, which is a contra liability account. It has a debit balance. So what does it mean here? What did the market want in comparison to the 9% that we're paying? They wanted more. They needed something more than the 9%. And so they got more by giving less up front. All right? So this $7,702 is really extra interest to the bondholders over the next 5 years. All right? So here's, okay, this is the slide is just backwards. Here's the 200,000, 9%, 5-year at 96.19. The market interest rate is 10%, and I'll show you how we get to that price here. How we can calculate that price using present value tables. So we're going to increase cash with the debit for the price, and that's this debit to 192, 298, and then we'll increase this discount, this contra liability. So that's here. And then we're going to amortize that over its life. And I'll talk about how we amortize this $7,702 over the life, the 5-year life. So what if it's a premium? What if the market only wanted 8%? If they only want 8%, they're going to reward you for your generosity because you're giving them 9. You're giving them the $9,000 every 6 months. They only wanted $8,000. Okay? 200,000 times 8% is 16,000. They only wanted 8,000, you gave them 9. So to reward you for your generosity, they didn't give you $200,000. They gave you $208,200. That's a premium. So the debit to cash is the full $208,200 sale price. Now you have an adjunct liability account of $8,200. Bonds premium. Okay? All right, so how do we calculate this? We use the present value. Present value tables gives you the value today of cash in the future. Does everyone agree? It's better to have cash in hand today than a year from now. If you got a birthday card from your relative that says, I'm going to give you $100 next year, you would all be grossly disappointed, wouldn't you? You would start questioning the mental facilities of your aunt or uncle that gave you that card. Because what can you do with cash today? You can spend it. In the case of a business, you can buy revenue-generating machinery. You could also pay down debt. If you pay down debt, you're saving the interest expense on that debt. Bonds have two cash flow streams. They pay interest on a periodic basis, primarily semi-annually, and then they mature at some time in the future and pay the full face value to the bondholders. The face value is the present value of a single dollar. One payment for all $200,000 sometime in the future. In this case, it was 5 years from now. But it's also paying, 9% annual rate. Oh, and this is 20,000, not 200,000, so we're back down to what, 20,000. It's also paying $900 every 6 months. That's what is known as an annuity. That is the same payment over multiple periods of time at some amount. Now let me show you the tables that they're talking about. Because they're looking here at, and the market rate at the time was 12%. So this is what the tables look like. They're in the back of your book. There are 4 tables back there. Oh, sorry. There's 4 in intermediate. There's 2 here. Present value of $1. If you wanted, going back to the I'll pay you $100 a year from now example, if you could earn 10% interest on that $100, if you put it in a savings account today, you can't. I understand that because of current market rates, but let's say you could. That's the equivalent today of $90.90. Because if you had $90.90 to save in a savings account that paid 10% interest, how much interest would you earn on that $90.90 over the next 12 months? $9.09. Which would have given you $99.99, I understand. But that's because this table only goes to 3 decimal points. All right? So that's the way the present value of $1 works. Table number 1. Remember this here. Well, actually, remember this one, easy. This one's 99 cents, because if you only earn 1% interest, $99 is going to give you $0.99 in a year. Okay? So that's going to give you the full $100. So look at this, 99 and 98. All right? Remember those two. Let's look at the table number 2, the annuity table. Come on. Oops. Where is it? Oh, come back here. There we go. The first row is the same. Because the present value of an annuity that's only going to pay one single payment is the present value of $1. Same as table number 1. But look at row number 2, 1.97. Do you remember what the first two were? 0.99 and 98. If you add those two together, you get 1.97. That's all table number 2 is doing, is adding together all of the factors that are in table 1. Because what is the present value of 2 payments? Well, it's the present value in 1 year of one payment, and then it's the present value of a second payment in 2 years. So that's all this table is doing, is adding up those factors. Okay? So let's look back to this example. The tables all assume annual payments. Well, this is a bond that pays semi-annually. So in reality, how many payments is it making over a 5-year period of time? It's making 10, right? It's making 10 payments. In reality, what is the effective, the actual interest rate that that bond's paying over the 10 periods? It's half of the annual. If it's paying 9% annually, 9% of $20,000 is $1,800 annually. In reality, it's paying it twice a year, $900. So what you're going to do anytime you're dealing with semi-annual is you're going to double the number of periods from 5 to 10, and you're going to halve the interest rate from, in this case, 12 down to 6. Now that's the last comment. And I'll say this again on Wednesday when we're doing the problems in the book. Remember, this is open book, open note. So somewhere in your notes you need to write, or in your book, or put a sticky in there if you want to sell it and you don't want to write anything in the book. Put a post-it note in there on the present value tables. Use the market rate. All right? Because what will happen if you use the face rate? It'll be exactly the face value. In this case, we got a $20,000 bond. If you were to use the face rate, which is 4.5%, so there's your problem already because you don't have a 4.5% factor in your tables. But if you were to use that, you would get a price equal to the face. It would be exactly $20,000 because at that point the market rate and what you should have used and the face rate, which you accidentally used, are the same. So if you get to the final exam and I give you a $100,000 bond, and when you get all done looking up the factors in Table 1 and Table 2 and multiplying it all out, you come up with $100,000 or something really, really close to that, $99,996 or $105, you used the wrong rate because I'm not going to give you a bond that doesn't have a premium or discount. Okay? All right, so 6% at 10. If we come over to table number 2, we look at 6%, we go down to row 10. We get a factor of 7.36. Yes, sir?
There's not a page on this in the back of the book, right?
Yeah, it's in the back of the book. This one in particular is 686. And it says that on the course outline. Yeah, here's the page numbers of the...
I don't see 686.
These are the page numbers for a really old book. Those were the page numbers at some point in time. Right now it's at 686. Table number 1, which is 684, by the way. Table number 1, you go to that same 6% column and go down to row 10, you get 0.558. Whoops. $900, the annuity, times 7.36 is a total of $6,624. The $20,000 times the 0.558 from table number 1 is $11,160. A total of $17,784. That's what the bond's going to sell for. It's a $20,000 bond that you can buy for $17,784. Why? Because you needed 12% and they only gave you 9.
No, they needed 9 and you.
No, you needed 12%. So it's selling at a discount.
So it's supposed to be 9.
9 is what it's,
What is that?
that's the face value. Yes.
Market value is 12?
In the market value is 12. The market interest rate today is 12%. So the bond is going to sell for $17,784. You're going to buy it for less because they're not giving you enough money. Does this make sense?
Yeah. Now you got the bulk of the 6%.
We gotta, every time the problem, we'll always have to give you that. And the 6% that we looked up is because it's semi-annual. All right? It's paying every 6 months. So you're doubling the number of periods and you're halving the interest rate. Okay? The periods is called N. That's the number of periods. It's a little n. And the interest rate is little I. So I is divided in half for purposes of the table, and N is doubled. Okay? All right. What if the face value was 8%? Oh, I'm sorry, the market was 8% and you're paying 9. So now you're going to go to the tables, and rather than the 6% column, you're going to look in the 4% column. 4% in table number 1 at row number 10 is 0.676. On table number 2, 4% is 8.111. 8.111 times the $900 is $7,300. 0.676 times the 20,000 is 13. Now they're going to sell for $20,820 because the market only needed 8% and you and your infinite generosity agreed to pay him 9. Because think of the steps involved. In order to issue a bond, a company has to decide to issue the bond. We're going to raise some money by issuing bonds. We don't want to sell any stock because we want to keep all of the stock we have. We're going to sell some bonds. You then need to put together a motion for the board of directors to vote on. How much are we going to issue? When are we going to pay it back? How much interest are we going to pay? And how often are we going to pay that interest? You have to decide all this months in advance because the board of directors has to authorize the issuance of these bonds. And once the board votes, yes, we're going to issue it, then you have to print up the bonds. You have to go find somebody to help you sell them because it's a marketable security. So oftentimes you get underwriters involved, the same as if you were issuing stock. And then you, on the issue date, you put it out there in the marketplace to actually sell. You're always going to guess because you want, if you need $2 million out of this bond, you want it to sell for $2 million. So you're always guessing, but you're having to guess in advance. You have no way of peering into the future and knowing exactly what the market is going to need on that particular day. If you've got that ability, come see me after class. I need to know 6 little numbers for Wednesday night. Okay, just if you've got the ability to do that. And actually, I wanted it last week when it was worth $17 million or whatever it was. It's only worth 3 or 4 now. Okay, so that's why bonds always continue. And if you look at the pricing sheets on that Wall Street Journal out there, you will, on a big page with literally hundreds of bond quotes, you will occasionally see one selling for 100. That was somebody who guessed right. But it's a rare, rare day. Okay? Every once in a while, somebody gets it right. And they pay exactly what the market wants. But most period. So here's just a graphic of the difference between the discount. Okay? So this is a bond, because these are all the payments of the $900 that you're paying every 6 months for the next 5 years. And then you have a single payment of the maturity. Here's the one for the premium. This one sells for less because the market needed 12%. You're only paying 9%. This one paid more because the market wanted 8% and you're paying 9%. All right. The last part of this chapter is that what do we do after we sell it? Well, we have to calculate the interest. There's 2 ways. An interest expense is either increased in the case of a premium, because you're paying, in essence, extra interest with this, in the case of a discount, because extra interest. The discount was the market wanted more than you're paying. Or you're paying less interest than cash. You can amortize it one of 2 ways. You can either take the premium, divide it by, in the case, the example that we just did, divide it by 10 periods, and amortize it equally over the life of the bond. Or you can use the market rate and calculate effective interest. All right, which is take the amount that is lent, the amount outstanding, multiply it by the interest rate, calculate what the interest expense could be, add or subtract that amount from the cash that you pay, and then increase the bond face or decrease the bond face depending upon whether it's a discount or premium. So which one do you think I'm going to want you to do on the final? This one or this one? This one, yeah. This one's too darn easy. It's not even worth. You just, yeah, back when we were doing on this over here. Okay, so this one it sells at a premium of $820. You would just take an extra $82 and add it and subtract it from the interest rate. Same every 6 months. That's it. That's too easy. All right, so back to the market interest rate is 10%. You're giving them 9%. So they sell it for $192 with a discount of $7,702. We get to the amortization. Here's the table. And I'm not going to give you a bond that's got 10 periods. It's way too much calculation on the manually on a test. I give you a 5-year bond that pays once a year. So the market wanted 5%. I'm sorry, 10%. You're only paying 9%. So you're paying $9,000 in cash every 6 months. If you take the carrying value of the bond, which is the face value less that $7,702 discount on bonds payable, you take the $192,298, multiply it by the market rate of 5%, you get $9,615. Because at the end of the 5-year period, what does the bond need to be worth? What's the carrying value of the bond when it matures? $200,000. So how are you going to get there from here to here? You're going to have to add something to it every 6 months to get the carrying value up. So you're going to add the excess of the expense over the cash that you paid. $615. Now the bond has a carrying value of $192,913. Multiply that by 5%. You get $9,646. That's how a discount works. What about a premium? How's a premium going to work? If you sell the bond instead for $208,200 because you're still paying 9%, but now the market only needs 8%, you're paying them more than they want. Your calculation of 4% times 208 is only $8,328. You're paying them more. You're giving them $9,000. That's an excess of $672. You lower the amount that you owe. Because once again, at the end of the 10 periods, it has to be worth $200,000. That's how it works.
It's always $200,000?
Well, in this case, but I mean, I could give you anything. I could give you $5,000 because I make up the numbers. Okay? All right. We will discuss